Hey everybody, it's Daniel here from InfoRez. Hope you're all doing well. So we had the US inflation numbers came out hotter than expected. We had the core CPI month over month coming out 0.3% versus the expectation of 0.2. We had the year over year core CPI number coming out 3.3% versus 3.2%. The headline number, which is 0.2%, expected 0.1, and the headline year over year number, which you're going to hear in the media, 2.4% versus the 2.3 expected number. So we got a hotter number here than expected, which caused basically the stock market today and the bond market to initially sell off. Although the stock market today was it was a little bit more choppy, and the bond market on the other hand went up, right? Completely ignoring the inflation numbers. You would think that the bond market would sell off on it. Well, in fact, the bond market has been selling off for many days now, and we saw especially the 10-year yield break above the 4% level. We saw a lot of the yields on the bond market move up higher, making those mortgage rates moving up higher as well, and creating fears on social media and everywhere else. However, the equity market, on the other hand, completely brushing it off. Except today the CPI numbers, it was more choppy. Although we did see closer to noon, the equity markets basically recouped that loss. But then again, right after that, we saw some selling pressure again in the equity markets later in the day. Now, what does this really mean? Well, let's look at what the markets are pricing in terms of rate cuts, right? We went from we had a 50 basis point rate cut, and we had a lot of traders and the market participants expect that we're going to get another 50 basis point rate cut in November, to now that being completely out of the question, and we're seeing now a 25 basis point rate cut being priced in. Now with the higher inflation numbers, is the 25 basis point rate cut still on the table? Well, according to the probabilities, we still have an 83% chance that we could get a 25 basis point rate cut, even though the inflation numbers ticked up higher. There is a slight 17% chance that there's no rate cut in November, and these probabilities can definitely change from now until November 7th, when the next FOMC Fed meeting comes out. Now let's look a little bit deeper into the CPI report, what it has to say. So it says here the CPI increased 0.2% on a seasonal adjusted basis, the same increase in August and July. Over the next 12 months, all items increased 2.4% before seasonal adjustment. The index for shelter rose 0.2% in September, and the index for food increased 0.4%. Together, these two indices contributed 75% of the monthly all items increase. So if you want to argue that the other components are doing better, and as we've been hearing from the Fed, that they're basically won on inflation, their focus now is on the employment side of things rather than inflation. You could say that by just nitpicking the data here and nitpicking certain items and say, hey, we quote unquote won. However, like this report says, 75% of all the monthly all items increase contribution comes from the shelter and food, which are the two essential items that you and I need and that we live off of. And those are the ones that are the most expensive. The food at home index increased 0.4% in September, and food away from home index rose 0.3% over the month. The energy index fell 1.9% over the month after declining 0.8% the preceding month. The index for all items less food and energy rose 0.3% in September, as it did in the preceding month. Indexes which increased in September include shelter, motor vehicles, insurance, medical care, apparel, airline fares, the indexes for recreational and communication were among that decreased over the month. So when you look at this report here and you go through all the items in the CPI, right? Food is still elevated. Obviously, the energy commodities they're down, they're negative. We see here new vehicles, 0.2, little bit of an increase there. Apparel 1.1% for September. Medical care negative. Shelters up there. Transportation's up. Medical care services. So basically, your essential items are up, and in terms of the other ones, not so much. So what does this truly mean in terms of rate cuts, in terms of where is this economy going, where is this market going, what's happening, are we getting this deflation that everyone expects, or maybe some people expect, maybe not everyone, or when is this inflation coming down? Well, for two things. Number one, inflation has, when you look at the index, has come down over the months, over the year or two, from its peak that we saw in 2021, right? And we see today's reaction in the bond market completely ignoring it. We see that we're still expected of a 25 basis point rate cut in November. We see the equity market as well holding up there, even though it was choppy, but I would say it's still kind of bullish because it's holding up there. We didn't get a massive sell-off there. So it doesn't change anything, ultimately, at the end of the day. It doesn't change anything. We're still going to get the rate cuts. It may not be as aggressive like another 50 basis point rate cut and so on, but it may be slow and steady rate cuts, right? Slow and steady rate cuts of 25 basis points in November, maybe another 25 basis points in December, and so forth. Until when, right? Until when the panic kicks in, until when the equity markets are, after done, let's say, melting up, and after figuring out that, they've got the rate cuts, they're getting the rate cuts, they're getting 25 basis points, what to expect now, right? Whenever you get that meltdown in the equity markets, or you want basically the financial markets to dictate what the Fed has to do, we see that often from the bond market, you will see some sort of tantrum if you want more rate cuts, if you want something for the Fed to do. Otherwise, the Fed's not going to do anything unless we see that tantrum event. And that tantrum event comes down to that crash, that recession, right? People who are expecting deflation don't think that's a good thing, because generally we tend to see that during crisis, during a recession, right? The yield curve still, hasn't steepened much. We've seen a flattening in the yield curve, and we haven't seen it steepen much just yet. It has steepened over the past couple of days, and we start to see the yield curve go positive, but we haven't completely seen it go into full throttle where it steepens aggressively, right? And that's another clue as well, that we're seeing from the yield curve, from the bond market, also the fact that the bond market was selling off, is that you're getting this consensus of this no landing, soft landing narrative, which is keeping the yields higher, bond prices coming down, those mortgage rates higher, yet the equity markets continue to march up, basically on the idea that, hey, everything's fine, everything's going to be okay. This is no landing, soft landing scenario. However, things can change very quickly because, like I said, the Fed's watching the employment numbers, right? Although, yes, the non-farm payrolls that we saw before, last non-farm payrolls came in stronger than expected, a lot of people attributed that to, maybe government jobs being increased, which is basically making the numbers look bigger than usual. And also, let's not forget that every time that these numbers come out, we see revisions to the downside. So we could see also this number being revised lower, right? So it doesn't rule out still that number coming out weaker. And like I said, the focus is on the employment side of things. And when we see the initial jobless claims numbers that came out today came out at 258 versus 231,000, which came out worse than expected. That's where the focus is going to be. So we're already in the rate cut cycle. It's just a matter of how aggressive the rate cut cycle, starts to end up looking, and when does that aggression come. That generally aggressive rate cut cycle comes when there's some sort of event, some sort of panic, right? When you get that tantrum from the market, then you get the reaction from the Fed. You're not going to get the reaction from the Fed to all of a sudden do a 50 basis point, 75 basis point, just because, they want to be your best friend. They're not going to do that, right? You're going to get the reaction come in once you see the tantrum in the equity markets, bond markets, and so on, right? But mostly the equity markets. So that's what happened today. Closer to the end of the day, today we're seeing here a bid in the futures market, in the equity markets here. Nvidia was quite strong today. Bitcoin sold off on, that news as well. And the bond market's still holding up a bit. So we'll see how this plays out, especially with geopolitical news. And I think what's going to be important is we want to see that data. We definitely want to go past now the elections time, because I feel that it also has somewhat of a play here. With the elections, a lot. I don't want to throw any conspiracy theories or anything out there, but like things can be skewed in such a way, especially with just 1 month's data or not. But we want this to finally pass so we can move on with, okay, where is this economy going now that we know a certain candidate is in, a certain president is in, and now let's focus back on, okay, where's this data going? Where is it being heading towards? What's the bond market saying? What's the yield curve saying? What's the equity market saying, right? And all of these things. What are the policies that are going to come out? How is that going to affect the financial markets, the economy, the jobs? How the jobs report is going to come out? How's that going to look like in January 2025? In the first quarter, second quarter, third quarter, and especially at the end of 2025. It could look very, very different than what we're seeing today. So anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified in the next video, and I'll see you guys around. Cheers. Bye.